What should I know about Veritasium?
It was under the blood moon. I felt my heart come. I held you in this strange light, a place where shadows run. And as I kissed your glowing skin.
So basically, I'm looking to tie the entire world through Veritaseum. Welcome to the episode that illustrates JP Morgan's terrible, horrible, absolutely no good second quarter of 2020. Yes, that's right. This is the exact opposite, the antithesis of what you've seen in all the pop media rags, business rags, CNBC, Bloomberg, etc. Right? JP Morgan had a horrible quarter. I'm going to walk you through it. This is the only place where you get the hardcore financial truth. You're going to get it often. As I've stated in previous videos regarding the apocalypse, which is not as much of an exaggeration as I'd like it to be, but the significant downfall, the second coming of the depression for real estate and for financial services and the economy in general, employment is the key driver here. Okay, during the Great Recession of 2008, the unemployment rate was significant. It wasn't the highest it's been in the history of the country, but it was the sharpest spike. So it was the most significant. And then you also have the unemployment claims, state-by-state unemployment insurance claims, which also spiked significantly. In 2008 through 2010, it was the highest climb in the history of record keeping, which didn't exist back during the Great Depression era. Now, compare that to what we've been going through over the last 17, 18 weeks. Okay, and you get to see what was the worst financial crash and economic debacle in modern history, save the Great Depression. It is minuscule compared to what we're going through now. Keep that in mind as we go through JP Morgan's results. And in regards to JP Morgan, we're going to jump straight into it. And we're going to start with the serious stuff first that everybody seems to disregard. And then we'll go through everything else step by step. Oh no, look on the screen. JP Morgan, earnings surprise. Ridiculously high trading earnings. Takes everybody by surprise. Not just, the run-of-the-mill media bastions, but even Barron's, one of the most, the oldest, most revered financial rags out. You see, if you take a look at everybody's perception of JP Morgan's earnings, it comes from the fact that they simply listen to what management tells them. People do not get their hands dirty, dig into the books and research. Now, one reason could be because that's the way the system works. I've been known from doing that. If those who don't know me, my team and I called the Bear Stearns collapse months in advance, the Lehman Brothers collapse months in advance. General Growth Properties, the second largest mall REIT in the country, we called their bankruptcy and their demise. And about 86 other calls. Commercial real estate, residential real estate, Google up, Apple down, etc. Well, it's time to get our hands dirty. Not everybody appreciates that. Remember, our government called me a fraud and a so-called financial guru. This so-called financial guru reads. So, in direct contravention to what Barron says and all the other news sites and all these other analysts, let's take a look at exactly how well JP Morgan did this quarter. And keep in mind who you should be listening to and why. So, if you were paying attention to the scrolling video just a few seconds ago as I was speaking, you see the analyst was saying that JP Morgan had record trading earnings, but also that it wasn't showing signs of consumer stress as of yet. And every single analyst and earnings report and analysis that I've seen or read said the same thing. And again, they said that because they're not getting their hands dirty. You don't have to get your hands very dirty. Just get a little something under the fingernails by scratching the surface. You see, they're going by what JP Morgan says and not by what is reported. So, if you haven't read it, just scroll back a few seconds, read that little scrolling white blurb. It's just a couple of seconds, and then fast forward back up to this point, and take a look at the graphic that is this video is superposed against, and it shows JP Morgan's 30-day delinquency rate. When I looked at it, I was saying, damn, that's rather good. You know, there's no change in the 30-day delinquency rate in any of the major lending, consumer lending sectors, okay, or departments throughout the last 5 quarters. And that says a lot considering the rampant unemployment, which you've seen in that graph from Fed, the St. Louis Fed, the fact that all stores are boarded up practically everywhere, even in the greatest metropolitan area in this country, potentially the world, New York City, and many other cities. And the fact that we're in an obvious deep recession. So, how is that? You see, when I saw that, the first thing that came to mind was, it's hard to believe. Unbelievable. So I had to dig further. Everybody else sees it, and they don't agree with the alleged or so-called financial guru or the alleged fraud. As you can see, I'm very salty about these allegations. But let's take a look at what happens when you actually go through JP Morgan's reported documents, okay? And then we scrub them again using the Veritaseum analytical team. You see, buried deep within the JP Morgan financial fine print, you will realize that JP Morgan has created COVID relief vehicles, okay, or programs, which are giving relief to those consumers who are having problems paying, forbearance, and other packages. I don't want to opine as to exactly what those packages are, but basically, these payers are not paying according to the actual contract. They're paying late, minimum payments, below minimum payments, etc. Normally, this will all go into the 30-plus day delinquency category, but they weren't. You know, they were taken out of that category and simply glazed over. Now, of course, there's a legitimate reason for that. You know, consumers are in trouble. The government has mandated that banks will give these consumers some relief. But there's a difference between mandating some relief and then acting like such relief was not given and everything is hunky-dory. So as we add back the tens of billions of dollars, so this is not a small amount of money, okay, that was given this restructured loan relief, you see a very, very different picture than both what was reported by JP Morgan explicitly without this, again, so-called financial or self-proclaimed financial guru that called these other bank mayhaps in the past. There's a big difference between what was reported and what this financial guru and their team has dug up. So take a look at this graph and tell me if you see a difference between the previous graph and what every other financial analyst and storied media rags such as Barron's and CNBC, Bloomberg, etc. have reported and what we've reported. I'm pretty sure this is the only place you get that information. And I'm going to do this for each and every other bank. We have reams of stuff. The only reason why we don't have more of it out quickly is simply manpower. Take a look for yourself. Now, before we go on, let's take a look at what this graph actually represents. Number one, it represents the truth, okay? And personally, JP Morgan is an excellent one bank, by the way. You know, Jamie Dimon seems to be a very good CEO, chairman. He sits on the board of the Federal Reserve, and that's most likely where that big earnings surprise came from, just as the chairman of Goldman sits on the board of the Federal Reserve as well. And the Federal Reserve is doing an unprecedented liquidity injection into the markets, buying and manipulating bond and stock markets significantly. Most likely doing it through the banks, hence these, you know, record trading revenues. Okay, but it is what it is. I'm not faulting them for that. I'm sure if I was CEO and chairman of Goldman, JP Morgan, I would do the same. But what is misleading is the fact that you're representing as the bank that credit issues have been untouched thus far. It's far from the truth, okay? Far from accurate. Now, if you take a look at home lending, right? The home lending 30-plus day delinquency rate, that's 30-day and 90-day rate, is through the roof. Historically, and we're just getting started in this COVID debacle, historically, I think this is the most the banks ever recorded. Not reported again, but recorded. And then take a look at how much they've reserved for credit loss allowances. Okay, they haven't come close to reserving what was necessary for just this quarter. Next quarter is guaranteed to be worse. Okay, guaranteed. If you take a look at the next section, which is, or the next lending category, which is cards, credit and debit cards, they reserved a legitimate amount. They reserved a little more than the actual losses, assuming they're going to reserve some more next quarter because those losses are going to build because, as I said, things are getting worse. And then take a look at automobile. Again, they reserve close to nothing relative to what the current losses are, or at least the current prospect for losses, the 30-plus day delinquencies. And the difference between automobile and home lending is that the home lending collateral will only depreciate but so much. It's going to depreciate because banks like JP Morgan, etc., are going to lend less. That liquidity squeeze is going to create less demand because less people will be able to buy houses at higher prices. It will drive the price down. Not to mention the other fundamental factors and macro factors, such as the rampant unemployment that we went through earlier. But with auto, right, automobiles depreciate by default, by nature. So you have significant late payments in autos that have been glazed over, okay, at least in terms of reporting. And then you have minuscule allowances for credit losses going forward. Okay, it is almost as if the credit loss allowances were being made upon the reported numbers versus the numbers that are actually the truth, which is what you see here. Okay, home lending and automobile. Now, you're going to see significant losses in corporate lending, okay, and a variety of other categories as well, but that's a little more than the scope of this video has time for. Here you have an overview of JP Morgan's credit provisioning across multiple lending sectors. You can see where the provisioning for the last 2 quarters have been significant across most credit sectors. It looks like a lot, and it is a lot, but as you can see from the first half of this video, what looks like a lot is not even close to being nearly enough. Okay, expect these provisions to spike significantly. Again, regulators, investors, pundits, analysts, it's time to get on your grind. Okay, JP Morgan is the largest bank in the U.S. by assets, one of the most well-respected. And from this particular pundit's perspective, they are not nearly conservative enough considering the losses coming down the pike. Of course, I could be wrong, but I wasn't wrong with Bear Stearns or Lehman Brothers or Countrywide or Washington Mutual or a variety of many others, General Growth Properties, and I don't think I'm wrong this time around either. Okay, and JP Morgan is one of the banks who are in the better or best condition of the big unknown banks. Okay, it gets worse from here. So this is the top, and it goes downhill. Return on equity is one of the most oft used and reliable gauges of economic return on bank assets, profits, equity. Basically, it shows you how profitable the bank is. Well, this graph says it all. Remember, we're just getting started with this depression/super hard recession. Okay, we're in the beginning of the COVID cycle, and in terms of opening up the economy, at least 18 states are rolling back, most likely 26 states, and they're going to be forced to roll back significantly. And that's not even considering the potential for a second wave. And no schools have started yet, and schools are probably the primary transmission vehicle for infection. So, and if you look at the first video that I've made in this series, COVID is an inconvenient or a convenient excuse for a massive everything bubble that was popping anyway. So you can't blame everything on COVID. To be truthful, you can't blame any of this on COVID because COVID exacerbated this by a significant amount, a massive amount. but it was something that was happening anyway from all the sweeping under the rug and kicking down the road, can kicking that was done from the 2007 to 2010 crisis. So take a look at JP Morgan's return on equity and then compare that to their credit losses as reported. That alone should tell you there's something wrong. But let's go and look at the other metrics as well, in case you didn't get the point yet. This is JP Morgan's balance sheet asset interest rate analysis. Basically, it's analysis of the interest earned on the assets held on the balance sheet of JP Morgan. If you look at it, everything is trending downwards significantly. Every asset is earning less and less in terms of interest, which means JP Morgan either makes less money or has to engage in significantly more risk in an attempt to make the same amount of money on its deployed assets. Okay? Hence, that return on equity, as you see going down, is going down simply because the interest rates on its assets, which were purchased by every equity that was leveraged up to purchase said assets, is going down. So they're making less money. In order not to make less money, they have to take a lot more risk in a very, very risky environment. This is what happens when you have ZIRP, zero interest rate policy, which is what the Fed has been pursuing since 2008. And banks' primary business is lending money. That's their primary business. But if you take a look at Goldman Sachs, if you take a look at JP Morgan, and any bank that has done well, at least in terms of accounting earnings, okay, generally accepted GAAP accounting earnings, not economic accounting earnings, they've done well by being basically a hedge fund in a trading house. Okay, their lending practices are already in the toilet, as you can see here. Okay, and the freebie that's given for the free trading house hedge fund activity, and that's hedge fund without the hedge, of course, has a very, very short lifespan because the Fed can only print and buy but so much over time before it destroys its own markets, which is happening right now. Because if we take a look at the equities market, stock prices are going up, earnings are going down, and the potential for increased earnings are opaque, to say the least, to put it politely. Absolutely unknown, politically correct way of saying it. You know, no way in hell it being better in the short to near term or medium term is the most accurate way of saying it. Here you have an analysis of JP Morgan's net income. As you can see, all net income is falling off of a cliff everywhere for multiple quarters, except for trading. Okay, trading is held in the corporate and investment banking department, and the trading is A, significantly risky, okay, even when you do sit on the board of the New York Federal Reserve, and B, unsustainable, C, very volatile, and let's pick D, it's not going to happen much longer. Okay, that Fed free punch bowl will be taken away either voluntarily or by the markets. Okay, the Fed is currently destroying free markets, free capital markets in the U.S. by eliminating price discovery, okay, and picking winners and losers, significantly distorting the market and pricing, taking all the risk away, throwing nothing but reward, basically devaluing the dollar to the point of who knows what's going to happen soon. There's a lot of room for it to move forward because, or it had a lot of room to do this because it's the reserve currency. Reserve currency status allows for a decent amount of debasement and bullying, but enough is enough in every regard, and it's quite possible that we're risking our status as a reserve currency holder. The only thing that's preventing it from happening now is there's no other currency to take its place. So, you know, we're not doing very well. We're doing rather badly, but everybody else is doing worse. So the U.S. dollar is currently the reserve currency holder with the deepest markets, the widest markets, the most liquid markets, but also the most manipulated markets in the entire world. Here you see JP Morgan's net interest margin. As you can see, the net interest margin is basically their profit margin, you know, their operating margin. From a pure banking perspective, the way the banking model works is you have some entrepreneurial group or person who takes some equity. Let's say they take $1 million or $1 billion of equity. They then go and borrow some more money to lever that equity up. So they take $1 billion. They borrow $20 billion. Now they have $21 billion worth of capital to spend. Now, that means if you make a 10% return on your assets, you'd make $2.1 billion on your $1 billion of equity. So that's basically, 110%-ish, right? It's a lot. Of course, if you lose 10% on your operations, you are now wiped clean. All your equity is gone, and you're in the negative, and you still owe the people you borrowed from. So that's how the banking model works. The larger the net interest margin, the more money you make on your banking and lending operations. This is not including trading and other hedge fund and speculative operations. And you can see the net interest margin has been trending down significantly. It's the result of ZIRP, the zero interest rate policy of the Fed. Basically, the Fed is trying to resuscitate and force feed economic growth in the economy, and is not doing it by injecting money into the real economy. It's doing it by injecting money into the financial economy, which is why JP Morgan and Goldman Sachs can have record earnings at the same time that the real economy companies are laying off tens and thousands, 30, 40, 50, 60,000 workers, going out of business, etc. Airlines, energy companies, manufacturers, industrials, etc. So this dichotomy is unsustainable, okay? But the Fed is still pursuing its boom-bust method of central planning. They are very smart guys, quite possibly smarter than I am. They definitely have access to much more information than I do. So far be it to me to second guess what they're doing. I can only sit here and opine upon the results, and we can see what the results are. Okay, now, at the same time that the Fed is forcing rates down, it's also significantly increasing the money supply. Okay, so when you force rates down, right, you have lower interest rates, you increase the money supply, you have monetary inflation. Okay, combined, that is a lower inflation-adjusted yield. Okay, gold has an 88% negative correlation to inflation-adjusted yields. So basically, when the money supply goes up, the interest rates go down, the price of gold goes up 88% of the time. Okay? Guess who happens to sell tokenized gold, transferable across the blockchain, redeemable for physical upon demand, with many, many other interesting and positive attributes. So take a look at the net interest margin chart, and then you see afterwards it goes to the negative correlation chart to the inflation-adjusted treasury yield. And then I want everybody to come to Veritaseum.com to purchase your tokenized VE Gold, VE Silver, and Palladium we're out of inventory on. Okay? Look forward to doing business with everybody. There are many, many more videos to come. Okay? We have several other banking names. We have also a banking trick that is used to hide and push assets off balance sheet. It was used significantly during the 2008-2009 debacle. It shouldn't have been used. It was abused. Gap wanted to eliminate it, but I'm assuming lobbying prevented that. And come the next debacle, roughly 10, 11 years later, guess what the loophole is that everybody's taking advantage of? So we'll go over that in the next video. Or we'll start picking more banks. I'm going to go through several banks, and we're going to point out exactly what is wrong with each of those banks. And we're not going to go through a valuation right now because valuations are useless. Fundamental analysis is useless. Math is useless in terms of share pricing, as long as the Fed is consistently manipulating share prices and financial markets. On that note, au revoir, zaijian, sayonara, peace.